Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, listeners from around the world. This is your host, Jason Hartman. Thank you so much for joining me today, and greetings from sunny Florida. Sunny and hot and humid Florida. It's not super pleasant here. A little bit of trivia for you. You know, in a place like Florida, you got to worry about something new. Alligators. Yes, alligators. That's really a thing here, and I know we have lots of listeners in Florida, but something that I learned amazed me. So a little bit of trivia for you here before we start the show today. Do you know that an alligator, when it's chasing prey, can actually run 30 miles an hour? Yes. Do not ever get close to an alligator, because if you think that that thing can't move, it can move 30 miles an hour. And then apparently there's this apparent, I'm not sure if it's true or not, myth going around that if you ever get in an encounter with an alligator, that you should zigzag. Supposedly, that's actually a myth, and it's not true. So there you go. There's your bit of trivia for today, alligators. Now, in the rental property business, you know, there is another use of that term, alligator. Yes, an alligator is a property with negative cash flow. It's this alligator around your neck, and you want to avoid that and avoid that. And if you have experienced challenges with your rental portfolio from time to time, which you will, if you haven't experienced them yet, get ready, because they come to every investor. I don't know. Maybe there are some investors out there that haven't had any challenges, but yours truly is certainly not one of them. I've had my share of challenges over the years, but the wonderful thing is, if you stay on course, if you stay on the path, the race is won by the people who continue, who go down the path and just keep going and have that dogged persistence no matter what the problems. And it's always good to ask yourself, compared to what, right? Is it compared to getting some lousy return in the stock market? Is it compared to investing in precious metals or cryptocurrencies and losing a fortune in one day? Now, granted, you can also gain a fortune in a day, I get it. But overall, income property, the most historically proven asset class in the entire world. So let's make sure we stay focused, keep our eye on the ball, as we are here in episode 1016. So today we are going to talk about robotics. We're going to talk about automation. Yes, the big job killer feared by many people. But the question is, and we've talked about it on other episodes before, is it really a job killer, or is it a job creator? Or maybe it's not a job creator, maybe it's just a prosperity creator. You know, it is truly amazing. Well, first of all, it's an amazing time to be alive, but it's also amazing the innovation of the human mind, how we can always find something else to do, and how capitalism allocates resources so efficiently that we can always find a new product, a new service, a new widget, a new something that other people will need or want. And we can sell that and create value in the marketplace. And we can't even imagine what these things are today. So that's the thing you've got to keep in mind when we have these fearful thoughts about technology and automation and them changing the future. The challenge always is, and this is the thing with real estate investments that always gets people, it's not the long-term trend. The long-term trend is always pretty good. the long-term trend if we're talking about technology and disruption from technology and the idea that it could be a job killer. The long-term trend is not that scary. What gets people is the short-term trend. What gets people when they don't follow commandment number 5 in my 10 commandments, thou shalt not gamble, when they don't follow that, when they speculate, when they buy properties that don't make sense from day one, what do? They get killed by the short term, right? There will be this transition in the market. There will be a transition in the economy, and it will typically be a good 2-year transition, if not longer. It might be a little shorter, might be longer, but allow 2 years, okay? Now, when you buy these expensive properties in the cyclical markets, and you go through the transition where the property is really in the trough, that's what kills you, where it's in the trough in terms of rental income because it didn't make sense from day one, because you didn't follow commandment number 5, thou shalt not gamble. Property must make sense the day you buy it or you don't buy it. If you didn't do that, then you are in the position where you are going to get burned and suffer greatly. So we want to avoid that, right? We want to buy these properties that make sense from day one. And the same is true with automation and the way it changes the modern alchemic economy, right? Because when we have these changes, it's the transition that kills people. It's surviving the transition period. That's what hurts. That's what gets people. Overall, the long-term trend usually cures everything. There's an old saying, well, I don't know if it's an old saying, but it's my old saying. And I always say, and I originally thought of this from relationships. I'd break up with a girl and I'd be really sad about it. And I would remind myself that time heals all wounds. Time heals all wounds. And time puts things in perspective. Of course, if you have children, you see how they get so upset and so sad about things, or so depressed about things, or so angry about things. And it's because they don't have the time perspective of an adult. And hey, it's not their fault. When you're only 15 years old and something happens to you, it's a big part of your life when you're only 15. But when you're 50, it's a small part of your life, and you've gone through it before, and you can keep it in perspective, and you have that maturity, and you understand that time heals all wounds. And that enables us to look at the long term, the big picture, to be able to back up. And it amazes me, and I'm sure you've been amazed by it too at one time or another, how many children are running around the world in adult bodies. Doesn't that amaze you? It amazes me. And, where they have this instant gratification mindset, where they are focused on the proximate, what's right here, right now, that's all I can deal with, and that's so immature. And it's such a bad strategy. It's so unsuccessful. You've got to look at the big picture. If you've been to a museum, when we were in Philadelphia doing our Philadelphia event, we went to this incredible museum with all of this amazing impressionist art. It's amazing. You look at the picture up closely and you can see the brush strokes, right? And that's sort of interesting, right? And that's why these people are the masters, because of the way they painted, and so on and so forth. But when you back up and you look at the whole picture, it looks even better. So always keep your eye on the ball, always keep your eye on the prize, always look at the big picture, always play the big game, not the small game. There's an old saying, you can win the battle but lose the war, right? Maybe that's appropriate to this as well, in a sort of a different set of circumstances or different context. But hey, before we get to our interview today with Ben Way and we talk about automation and robotics, I wanted to play a little Voxer message for you that I got from one of our clients. Now, this particular client was actually a contractor for us first, and he still is. You've heard him on the podcast a couple times over the years. Maybe you met him on our Florida property tour, and that's Naresh. And just to tee this message up that I'm going to play for you, it's a quick little message about his real estate investing. He just closed on another property, and he's building a very nice portfolio for himself. He's engaged. He's going to get married in December, he's done a lot of different work for us over the years. But I want you to know that I did not solicit this message, okay? He left me this message, and I said, hey, can you just leave that message again, but take out the other stuff we were talking about because it's irrelevant to the listeners, because I want to play it on the podcast. And so here is what he said, and I think this will be informational to you. It's just a quick message. Here we go.
So, Jason, I'm actually 29 years old. We've been working for, 5.5 years together? First time we talked, I was 23, and we started working together when I was 24. And knowing you this long, my only regret about real estate, I now own a few properties that I got through you. My only regret is I didn't get started earlier. I wish I got started earlier. And the reason why I didn't get started earlier is really quite simple. I just didn't know anything about real estate, and I didn't bother to learn more about it. Despite working with you, I just was very ignorant towards it. I just assumed that you needed a lot of money, like Donald Trump and all these people, Robert Kiyosaki, to buy real estate. I knew nothing about loans, mortgages, depreciation, tax deductions. And you would think, I have a master's degree in business, went to some very good business schools, worked on Wall Street. You would think I'd know about all this stuff, or at least be introduced to it in class or on the job. But no, that's not the case at all. I did not learn any of this until I started working with you, talking to you, listening to your podcast, being on your podcast, conversing with your investment counselors, coming to meet the masters. So anyway, I'm in my late 20s now, and I'm fortunate that I bought my first house when I was 28. And I'm very happy that I've gotten started with you, and I have the rest of my life to now continue and pursue this kind of hobby, I guess, in real estate. So thanks for that. And the other thing I should mention, Jason, is I learned now, but in my early 20s, mid 20s, since I was completely ignorant towards real estate, I put money in, guess what, the stock market. And again, you'd think, oh, if you put your money in 2010, 2011, 2012 in the stock market, you must be super rich now because the stock market has only gone up since then. Well, that's wrong. I lost a crap load of money in stocks. And it was partly my fault. I was young. I was trying to get rich overnight, essentially gambled it away in the stock market. But, that's what your 20s are for, I guess. It's for doing dumb things and learning from those mistakes. So what did I learn from the mistake of investing in dumb stocks? Well, invest in real estate instead. It's not gambling if you go your way of doing things. Safe, good rent to value ratios, good neighborhoods, high cash on cash. The numbers would definitely matter. And if you invest in good properties, then I think hopefully you can get wealthy down the road. Obviously nothing overnight, but so far so good. I'm happy with the way things have gone over the past year since buying properties from you, and I look forward to buying many more and also liquidating my stocks so that I could buy more real estate.
So that message that you just heard really explains the coulda, shoulda, woulda concept, right? We all have these regrets. We all have the coulda, shoulda, wouldas. And look, we can't change the past. We can only change our future by how we act today in this moment. And that's why it is so important to invest for your future, to invest more for your future, because there will be a time, I promise it will come. We all know it'll come. You don't have to rely on my promise because you know it without me even saying. You know that there will be a time, maybe it's 2 years from now, maybe it's 5 years from now, maybe it's 7 years from now. We don't know, but we know it will come. There will be a time that you will say, I wish I had started back then. And if you're not in the starting mode with your real estate investment portfolio, then you're in the building mode and you'll say, I wish I bought more back then. Why didn't I buy more properties? I had the money. Why didn't I do more? I could have done more. Shoulda, coulda, woulda. Regrets, regrets, regrets. The way to not have regrets in the future is to act today. Okay, so contact your investment counselor at jasonhartman.com. Get started. If you don't have an investment counselor, just go to jasonhartman.com, fill out any form on our website, and one of our investment counselors will reach out to you, and we will help you with that. Now, let's get to our guest, Ben Way, but before we do that, I want to tell you that we have 2 events coming up in early November in Hawaii, in beautiful, gorgeous Hawaii. This is the good time of year to go in early November. These events are a little ways away, but we're going to be announcing a fantastic early bird special. We are doing a totally new conference in Hawaii, a 2-day event that we have never done before. New content, new stuff, and in a beautiful, gorgeous resort location. We are at an iconic hotel on Waikiki Beach. I think the most iconic hotel on Waikiki Beach, and that'll be early November. And then we will have 1 day off in between, and we will have the Venture Alliance Mastermind Retreat in Kauai. I have always wanted to go to Kauai, and I hear it's the most beautiful place on the planet. So the big event, the conference, the 2-day conference is on Waikiki Beach, right near the airport, really easily accessible, direct flights from lots of places around the world. I hope some of our clients in Australia and Asia and New Zealand, that part of the world, will come to this event because we'll be a little closer to them. And then, of course, all our people from the West Coast of the United States, it's an easy flight for you. If you're on the East Coast, the way I recommend it is, hey, look, I'm an East Coast guy now. I'm in Florida, right? So that's a little bit of a trek for me. If you're on the East Coast, what I recommend is you just make it a point to stop on the West Coast and visit California or Oregon or Washington or Phoenix or Vegas or something for a day or two, and then you break it up real nicely. You know, we all have things to do in all these places, fun or people to see or business to do or whatever. So that's a really good way to plan it. But anyway, we will have a registration page for a fantastic early bird price for this event coming up real soon for you. So keep those dates open. Save the date, first week in November this year for beautiful Hawaii. We will have that very shortly for you. Okay, let's get to our guest today. Let's talk to Ben Way, and let's talk about robotics and automation and how they're going to affect us and our investments. It's my pleasure to welcome Ben Way. He is the CEO of Digits. He is a cast member of the Bravo TV show Startups, Silicon Valley, featured in the acclaimed documentary The Startup Kids, and author of Job Apocalypse, The End of Human Jobs and How Robots Will Replace Them. Ben, welcome. How are you?
I'm very good, thank you.
Good. It's good to have you on the show, and you're coming to us today from Miami, Florida, and I am in Fort Lauderdale, so we are close to each other, but on Skype. So
Indeed.
Yeah, we had a great conversation before we came on the air here. You are doing a lot of interesting, innovative things. First, tell us about Digits, a startup in the crypto space, it looks like, to do with cryptocurrency credit cards. Tell us more.
Yes, indeed. So about 3 years ago, I joined a traditional payments company. And to be quite frank, I knew very, very little about the payments industry. About a year ago, I recognized that there was a huge opportunity in the crypto payment space for a new type of crypto credit card provider that basically allows you to change any credit or debit card in the world, including the ones in your pocket, into a crypto card. And that's exactly what we did. And we came up with this concept of Digits, and we span out the company, and now we're doing an ICO for it. And the really interesting thing about Digits is that we're not issuing any physical credit cards. We're literally converting the credit cards that you have in your pocket right now into Cryptocards. So you can choose whether you want it on your credit card, whether you want to pay in crypto. And from a merchant's point of view, they get exactly what they were expecting at exactly the time they were expecting it.
So in other words, if you have a charge that you're doing on any given day and your cryptocurrency that is in the account that would be debited is at a high, or you think it's at a high, then it would be wise to maybe pay with the cryptocurrency versus the dollar, right? You're always arbitraging these two. Gives you that choice.
Absolutely, though one of the amazing things that we have done is that we had to solve the problem, the largest payment problems with crypto, which is volatility and network transmission time, which basically means that a merchant needs to get exactly the amount of money they were expecting at exactly the time they were expecting it. And so we had to solve those problems. And by solving those problems, we actually came up with quite a unique concept called the hedge lending network, which we believe is the first real-time lending platform in the world. And through that, the really interesting thing about digits is if you swipe that card today and you pay $100 in crypto from your crypto account, you have if you want, you have the option of paying back that transaction 366 days later in fiat and getting any uptick in the value of crypto. So if crypto doubles, then you can actually pay back the original transaction plus a small transaction fee and get the uptick in crypto. So you can actually hedge a year ahead with digits.
Okay, that's fascinating. So you said you could pay with fiat, I believe, meaning dollars, any fiat currency like a euro or a dollar, or you could pay with the cryptocurrency. But why, Ben? I mean, this is the story that's circulated widely about the 2 pizzas for $82 million or whatever when they're paid with Bitcoin. But why would anyone allow a 366-day float? That is a long option period. There's got to be a decent amount of option consideration to have that long of a period because, wow, it's a long time.
We've actually created a very unique model, which means that in 366 days, you can pay back that transaction in fiat. However, if the market has gone down during that time and it goes past a certain trigger point, then the crypto is automatically liquidated and the lender paid back. So we see that option as kind of being the icing on the cake of the transaction. If you swipe that card and crypto continues to go up, then you're going to benefit from that. But if crypto goes down and we liquidate it and pay back the lender, then you don't get that facility. But you've still spent the $100 you were expecting to spend at the time you were expecting to spend it. So we kind of see that facility as a side effect of our model. It's not kind of like a core proposition. It's just one of the many benefits. And the other major benefit is that we turn a short-term taxable event into a long-term taxable event that can save up to 30% of the transaction fee in tax. So it's these kind of two huge benefits that actually are just side effects of the way we built the whole system in trying to solve these two big problems, which is volatility and network transmission time. And in effect, the way we do that is the hedge lending network is a two-sided marketplace, and the hedge lending network itself takes the risk.
How do you turn any card into a cryptocurrency card, though? Is it simply because, I mean, I don't do anything with my American Express card in my wallet or my Visa or my MasterCard in my wallet. You do something with a back-end account, right? I don't.
Yes.
I don't even talk to my credit card issuer about this, right?
No, exactly. So the easiest way to explain it is that we kind of interrupt the payment before it gets to the Visa MasterCard networks, and we check whether it's a crypto registered card. But the really important thing is we still settle the transaction across the Visa MasterCard networks. So we play very nicely with Visa MasterCard. We're not trying to take them out of the loop. We actually leverage the value of their transactional network. And that's a very big differentiator for us, because by settling on the Visa MasterCard networks, it means that we don't actually have to deal with single merchants. From a merchant's point of view, it is just a normal credit card transaction. So it means that we can integrate at much higher levels and all the merchants below, who are attached to that, automatically are part of the digits program. And literally, we don't have to sign any agreements or anything, because we're just settling the transaction exactly the way
they expected it to be. Yeah. Okay. Yeah. Oh, very interesting. Very interesting model. Good stuff. I want to leave the topic of digits, if we can, and talk about your book, because I think it's a fascinating topic. But before we do that, is there anything else you want us to know about digits or cryptocurrencies?
Not really. Just if you're interested, check out the digits.io website. We're in pre-ICO right now. We're about to launch with Rengen Labs. And we want to build a really long-term valuable business.
Fantastic. Okay, so the future of jobs. I tell you, I have made many very good predictions on my podcast over the years, Ben. The one I have been a miserable failure at is interest rates. But hey, everything else has come true, so that's all right. If you didn't win the interest rate game with me, that's fine. But the rental market, the real estate market, all of that stuff, I've been pretty good at all of that. But the one thing I am really struggling with is the future of robotics and automation. And here's the reason I struggle with this. And, your book is addressing this topic very specifically. But, if you look at every innovation over the course of history, people have always been in fear that they would lose their job, that massive amounts of people would be displaced, that there would be economic collapse, etc. And that has never really happened. Looking at the census for the last maybe 50 years or so, the only job out of all job categories they cover that has gone away because of technology is elevator operator. We do operate our own elevators nowadays, so we don't need the guy sitting in there, picking our floor. But everything else is still there, really, right? But I wonder if this time it's different. And the reason I wonder is that, okay, self-driving cars, autonomous vehicles, the transportation industry is one of the biggest industries on Earth. But the people that drive your Lyft and your Uber and your delivery truck, they're not going to learn robotics. Will they just all be displaced into jobs we can't even imagine yet? I don't know. What will happen? What will come of this? Massive unemployment or, massive prosperity?
Yeah, I mean, there's a few ways of looking at this. So first of all, the data that you're looking for on who lost their jobs because of technology and automation actually is there. It's just hidden. And one of the analysis I did in my books, and where I believe it's hidden, is the amount of time for an economic recession to recover. So if you look at all the recessions from the beginning of this century, every recession has taken twice as long as the previous recession to recover. And the reason for that is that when an economy is growing, it becomes inherently more inefficient, and organizations don't want to change and they don't want to optimize. They're just happy they're making money, and they don't focus resources on efficiency. When you go into a recessionary dip, what happens is that organizations have to become more efficient, and they automate and re-automate. And what happens is that it takes twice as long each time that happens for the jobs to come back to the same level, because what you're seeing is actually that slack. So my belief is in the next recession, whenever that may be, is you're going to have a horrific recession which we may not recover from on a jobs basis, where you kind of hit a point of no return for jobs. And, I think, I do think the next major recession is probably going to be that point. And, you mentioned about the elevator operator, but actually there's thousands of hidden jobs that have disappeared. For instance, we used to fly planes with 2 pilots and an engineer. Mm-hmm. It had to be every single plane.
Now it's just 2 pilots.
Just 2 pilots. And so, we're getting to these points of efficiency where, just because something hasn't happened in the past doesn't necessarily mean it's not going to happen in the future.
Sure.
And innovation has been on a kind of quite a linear curve. And at some point, it's going to break the system of labor. And then coming back to your point, then there's 2 points of view. And I'm ever the optimist. So say, well, if we're lucky, we'll be treated like well looked after pets. Where life will be so good because what people forget with automation and AI and all that is the cost of everything decreases, right?
Mm-hmm. Right.
So, medical, the cost of medical, if everything's being done through technology,
it's very deflationary, no question about it. Yeah.
Exactly. So there may be a balance that can be obtained, but I suspect before we get to that balance, there will be a huge amount of social unrest before we get there.
You may be right. I mean, the prognosticators are predicting things like 47% unemployment from these mega shifts that are coming our way. Technology it feels like, and maybe it felt this way, Ben, when the steam engine was invented or the light bulb, I don't know. But right now, it feels like we're about to see a huge change in the world through technology, because we've had this networked world for 25 years or so, right? And it just keeps compounding the effects of it. So maybe it's like looking at the chart, the graph, and seeing that hockey stick of this exponential change. Certainly Peter Diamandis is talking about things like that very positively from his perspective. But I don't know. Let's look at the table of contents in your book, and maybe I'll just give you some fodder for conversation here. So I can't help but notice chapter number 3, the adult industry.
Everyone loves the sex chapter.
Right. Hey, listen, we're all human. What are you talking about there? I mean, I want to think that maybe you're talking about dating sites and virtual reality.
I'm talking about sex bots. Yeah. Having sex with robots and the sex industry and, how we're falling in love with robots and how there's no reason we won't fall in love. If we can fall in love with animals, we can certainly fall in love with the robots.
Right.
Those psychological studies are already proving that under the right circumstances, humans can form pretty strong emotional bonds with robots.
Wow.
So,
interesting.
It's fascinating. I think the real question behind this, so it could have great effects, like it could stop sex trafficking. It could really free a lot of people who are very lonely.
Yep.
What was that mass murderer, that kid in California that shot up?
In Santa Barbara, 10,
Santa Barbara. He shot up 10 people because, girls said no to him, right?
Yep.
Sex is important. It's part of the human condition.
Right, sure.
We need it.
Yeah.
So it can have some very, very positive outcomes. But more fascinating side for me is, and this is just from an interest level, is the psychological and moral issues behind it. For instance, is having sex with a sex bot, is that being unfaithful to your partner? If you create a robot that looks like a child, is that pedophilia? And if it is pedophilia, is it better that a pedophile
have an outlet,
uses a robot or a human?
Yeah.
So there's all these kind of interesting moral dilemmas that humans are going to have to grapple with in the next 10 years about their morality and what it is to be human.
This will be continued on the next episode. Thank you for listening and happy investing. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.